What if I told you that right now you could own part of the biggest companies in the world, making passive income with companies like Apple, Tesla, and Google, all without stepping out of your house? Sounds good, right? Let me break down how you can actually make that happen and why it's much more simpler than you think. What is the stock market? The stock market is literally where the wealth building game happens. It's where you go from sitting on cash that's losing value to putting your money to work. Here's the deal. Companies need money to grow, right? And they do that by selling shares of themselves. When you buy one of those shares, boom, you are now part owner of that company. Yeah, you're not running the show, but every time that company makes a move and it grows, so does the value of your share. Think of it this way. You're not just buying a piece of paper. You're buying a slice of machine that, if it's built right, is pumping out profits every day. And as that machine gets bigger, your piece of the pie gets more valuable. This happens on platforms like the New York Stock Exchange, or also known as NYSE or Nasdaq. Basically, these are just the venues where all the buying and selling happens. How stocks work. Here's what people overcomplicate things. When you buy a stock, you're betting that the company will keep crushing it. If they do, the stock price goes up and your investment grows. But on the opposite side of the token, if they screw up or the market freaks out, the price drops. But you're not in this to get scared every time the price fluctuates. We're in this for the long haul. There are two main ways to win in the stock game. 1, capital gains. 2, dividends. Capital gains is when you buy low and sell high. Let's say you buy an Amazon stock at $100 and it's now worth $200. That $100 difference is your profit or your capital gains. You didn't even have to do anything other than make a smart call up front. Simple as that. 2, dividends is when some companies pay you for just holding their stock. Literally, that's it. They take a cut of their profits and share it with you. These are called dividends. And it's like getting paid just for owning something that's making money. So you're either getting paid as the stock price goes up, or you're getting a slice of the profits just for holding onto your shares. Now you can see why this is a game changer. Stock market versus stock exchange. All right, let's get this clear because a lot of people misunderstand this part. The stock market is the entire system where all the buying happens and selling happens. The stock exchanges are the arenas where this game is played. Think New York Stock Exchange and Nasdaq. When a company decides it's ready to sell shares to the public, it gets listed on one of these exchanges. That's why you hear stuff like Tesla is on the Nasdaq or Coca-Cola is listed on the New York Stock Exchange. Same game, just different venues. How do companies get listed? This is where things get interesting. When a company wants to go public, it goes through an initial public offering, or also known as IPO. This is a fancy way of saying we're selling pieces of our company to raise cash. Before an IPO, companies are usually private, meaning only a few people own them. Think of small groups of founders, venture capitalists, or private investors. But after the IPO, now you and I can jump in and buy shares. That's how you, the average person, can get in some of the biggest companies in the world. Why do stock prices change? Stock prices are not random. They change based on how many people are buying versus selling, which boils down to supply and demand. If people are hyped about a company and think it's going to crush it, they buy more, driving the price up. However, if they lose confidence, they sell and the price will drop. Simple supply and demand. But what causes that demand? A few things. 1, company performance. If Apple drops a crazy new iPhone, people are buying the stock because they think the company's future profits just got bigger and the stock price goes up. If Apple reports bad earnings or a flop product, people sell and the price drops. 2, market trends. Look at industries. If the electric vehicle market is doing great, then companies like Tesla or Rivian are going to see their stock rise. The market is forward-looking. People are betting on the future, not the past. 3, economic factors. Broader stuff like interest rates, inflation, or unemployment. If the economy is strong, people are more likely to invest. If we're headed for a recession, they sell stocks and hold on to their cash or buy safe stuff like bonds. But here's the thing. Don't get caught up in the day-to-day noise. Stock prices will fluctuate. The key is understanding the long-term value of the companies you're investing in. Types of stocks. Let's simplify this. There are two main types of stocks: common stocks and preferred stocks. Common stocks is what 99% of people are talking about when they say stocks. You buy shares, you own a piece of the company, you can vote on certain things like the board of directors, and you get paid through dividends if the company does that, or capital gains. Two is preferred stocks, which are fewer people talk about these. They're kind of like a mix between stocks and bonds. You get paid to fix dividend, but you don't get voting rights. And if the company gets bankrupt, you get paid before the common stock holder. Common stocks are where you're gonna get the most upside. Preferred stocks are for more people who want steady, reliable payouts with as much growth. How do you invest in the stock market? Here's where people overthink things. You don't need to be a Wall Street genius to invest. Literally, anyone with a smartphone can start. Here's a quick guide. 1. Open a brokerage account. This is where the action happens. Platforms like Robinhood, E-Trade, or TD Ameritrade make it super easy for you to start. You open an account and that's where you'll keep your cash in stocks. 2. Fund your account. Transfer some money and you don't need a ton to start. Even $100 is better than nothing because the point is to start building. 3. Research. This is where you'll separate the amateurs from the pros. Don't just buy stocks because someone told you to. Look into the company's histories, financials, and future prospects. Are they growing? Do they dominate their market? Stuff like that. 4. Buy your first stock. Now that you've done your research, make a move. You can place a market order to buy immediately at the current price or a limit order to buy only if the stock hits a specific price. Stock market indices. When you hear people say the market is up or the market is down, they're usually talking about indices like the S&P 500, Dow Jones, or Nasdaq. These are groups of stocks that represent the market as a whole or a certain segment of it. The S&P 500 is 500 large US companies and is a good indicator for how the overall market is doing. Risk of investing in the stock market. Let's be real. There are risks. You can lose money, but here's the deal. Over the long term, the stock market trends up. The key is to not panic when things drop. This is a long game. If you invest $10,000 today, don't stare at it every day hoping it jumps to $11,000 by tomorrow. Stick with it. Historically, the market grows by about 7 to 10% annually, but that's over years, not days. Here's the conclusion. The stock market isn't just for rich people or finance experts. It's for anyone who wants to build wealth over time. And yes, there are risks, but the potential rewards far outweigh them if you play the long game and you do your homework. You're buying ownership in some of the biggest wealth-creating machines in history. Start now, start small, just start. If you want me to go over any specific topics that you're interested in, comment them down below. I will be checking those. Don't forget to hit that subscribe button, like, and share the video. It truly helps out more than you know. I'll see you in the next one.